On today's hot sheet, I'm discussing new legislation that proposes banning hedge funds from buying single family homes, home builder earnings, and credit card debt. Today is Thursday, December 7th, 2023. I am Byron Lazine, and the hot sheet starts now. All right, welcome back into the hot sheet here on this Thursday morning live stream. Let me know in the live chat which market you're tuning in from, and let's jump right into it. When I saw the headline first, where it said, um, a proposed bill and it involved real estate, our senior editor Vanessa over here at BAM sent me a bunch of articles to look at and consider for this morning. And I saw this one. I'm like, oh, what's going on? Congress, real estate, what is going on? More lawsuit. What's happening? And then I see it is Congress aiming to prohibit hedge funds from buying and owning single family homes in the United States. Obviously, there's been, from an inventory standpoint, a lot of attention on institutional buyers buying single family homes or buying too many. It's, I've made the point often that they don't own as many as it feels like, or as many as we think, although that accumulation is obviously on an upward trend ever since 2008, as hedge funds and Wall Street has found, single family homes to be an attractive asset on their books. But there's a lot of people that have this fear that, oh, we're going to wake up in 20 years and Wall Street's going to own all of these single family homes. So this would be a win for those who believe that. Let's get into the proposed legislation from Congress. The bill, named the End of Hedge Fund Control of American Homes Act of 2023. Again, this is a proposed bill. It's been introduced in both the House and the Senate by Democrats. It hasn't gotten passed. It has been introduced. You could imagine here, so we're not playing politics on the hot sheet, but Democrats introduce a bill like this into both the House and the Senate, um, you know, proposing that hedge funds are not going to be able to buy single family homes any longer to, as rentals. I guess technically maybe they could buy them and just sit on. They wouldn't do that, of course. They want that cash flow on the single family home. But Democrats introducing this bill into the House and the Senate is going to put pressure on the other side of the aisle, because it'd be pretty bad PR to say no, we want when there's low inventory, homes are at the most unaffordable point. Interest rates are high. All of these dynamics that are hurting the American home buyer. It'd be pretty insane to say, no, let's let hedge funds buy more homes. Let's take more off of the market. So, you'd think this would become a bipartisan, just off of, a PR standpoint, how it's going to look in the public. You'd imagine, there'd be bipartisan support here, but this was proposed specifically by Democrats, according to the New York Times, in both the House and the Senate. It proposes banning hedge funds defined as corporations, partnerships, or real estate investment trusts from managing funds pooled from investors from owning single family homes. Okay, so if you're raising money, getting investments into this fund, into this corporation, to use it to go and buy single family homes, this bill bans that. Okay. There's a bunch of these too that are popping up. I don't know, anybody in the comments knows a YouTuber by the name of Meet Kevin. He has a company called House Hack that is designed specifically to do this. He's been raising money. I haven't been following it closely enough to know if he's gone out there and started buying homes yet. He's waiting for what would be perceived as the bottom, or the big opportunity to get single family homes, and then go out there and start spending. But this would essentially ban that from happening if this were to be implemented. Also, if it were to be implemented, there would be a phased implementation. So it's not like, hey, you got to get rid of all these homes that you own tomorrow, there would be a 10-year phase out period because, if you're thinking what I first thought, I was like, oh man, if they're going to sell all these homes, we might get a little inventory pop. But there's a 10-year phase out period. And you could imagine, like we talk about here on the hot sheet all the time, tomorrow, the future is where the next real estate peak is. And it's somewhere in a 10-year period for sure. You can set your watch to it. You go back and look on it every 10-year period. There's a peak higher than where we're at today. So, some of these may say, hey, okay, if I got 10 years, I'll take 7 years of cash flow and hit the next peak and sell off then. So during the 10-year phase out, the bill imposes stiff tax penalties on hedge funds. So I guess it would depend on, okay, all these penalties accruing over the 10 years. Do they like, is year one and year two and year three like a ladder? That's a question I don't have an answer to right now off of this New York Times article. I have not read I will be honest here. I'm giving you the highlight version. There is a 14-page bill right here from the 118th Congress first session to amend the Internal Revenue Code of 1986 to impose a tax on the failure of certain hedge funds owning excess single-family residences to dispose of such residences and for other purposes. So there's a 14-page, bill here that might get into a couple of those questions that I'm proposing. We'll certainly try to dig through this here at BAM and probably put an article out with some of those questions, maybe even as soon as later today. But yeah, I'd be curious, like, is this going to incentivize the hedge funds to sell early in that 10-year process over the next 12 to 24 months and get some of the single family inventory back onto the market? Obviously, from a hedge fund standpoint, if Congress comes knocking on your door and says you got to sell these homes, hey, I got a lease right now. I mean, well, you can still sell the house with the lease. Oh, I can, but it's not going to be as attractive on the open market if there's 6 months left on the lease and the buyer can't get into the house, right? Hey, you're going to just shrink the buyer pool. That'd be an argument from the hedge fund perspective. But Todd in the comments says, so the end of syndicating there. Yeah, this would be the end of syndications for single family rentals, not multifamily rentals. Okay. So like I mentioned, that YouTuber Meet Kevin, for those that are familiar with him, for his single family syndication, this would be the end of that. For Grant Cardone style multifamily syndications, there's no signs right now that is in the cards to end. I think Congress would have a real hard time saying you can't pull money together for these big multifamily properties. Okay. So proceeds from these penalties over the 10-year period would be reserved for down payment assistance for individuals seeking to buy homes from corporate owners. Okay. Specifically for individuals seeking to buy the homes from the corporate owners. Potential impact. The legislation aims to disrupt a growing sector of the housing market and increase the supply of single-family homes for individual buyers. We'll get into some of the numbers here. How much are they actually going to increase supply? Remember, Congress has done some things and local governments have done some things that tend to support first-time home buyer assistance. Now they're actually taking an aim here on, can we increase inventory? Where can we increase inventory? I'd still love to see them do it from the top, from the creation of more supply at an affordable rate. But this is one way where they are taking a step to get inventory onto the market. Okay. And this is what I've been asking for. Hey, we need more supply. And so they're saying, hey, we have existing homes. The structures are built. They exist. They're just owned, in Congress's view, they're just owned by the wrong people. Let's get it out into the open market and ban hedge funds from the ability to go ahead and buy these homes. Rising home prices and interest rates have made home ownership increasingly challenging for ordinary Americans, is a position that the Democrats in the House and in the Senate are taking. Another related bill, the American Neighborhoods Protection Act, has also been introduced, requiring corporate owners of over 75 single-family homes to pay an annual fee for down payment assistance. So that they're trying, so that bill there, it's like, okay, let's do a heavier tax. And then this bill looking to ban this altogether. The bill follows a New York Times story highlighting the impact of corporate-backed investment in Charlotte, North Carolina, where investors purchase a significant percentage of homes, often out-competing first-time buyers. Charlotte, I'm super bullish on that market over the next 10, 15 years. So it doesn't surprise me to see that institutional investors owned 20% of single family rentals in Charlotte. They see the future. The future is obvious for Charlotte. They see that and they say, you know what, we're going to go ahead and rush to the market and buy these single family opportunities. So they own 20% of single family rentals in Charlotte. Despite a slowing housing market, they remained active, purchasing 26% of single family homes in June of 2023. These are two very different stats. Okay. Let's be careful with what I'm saying here. Institutional investors owned 20% of single family rentals in Charlotte. That's not single family homes. That's not all single family homes. Most single family homes are not actually rentals. Most single family homes are owner occupied. So they own 20% of the single family rentals would be institutional investors, which means 80% are still mom and pop, small time, most likely local investors for the single family rental pool. Okay. Like if you have, I don't, it doesn't get into the percentages here, but if you have all single family homes in Charlotte, there's a category of them that happen to be rented out, investment properties, right? Then there's a category that are owner occupied. Out of the category of single family rentals, that's where we see 20% of those owned by institutional investors, Wall Street, hedge funds. Okay. Now, the other stat is that institutional buyers actually purchased 1 out of 4 homes in just the month of June 2023 that were on the market. That's an incredibly different stat. 26% is a significant chunk of the active market. Obviously, it's an absurd chunk of the active market, where institutional buyers went and bought 1 out of 4 homes on the market in June of 2023. So they've put the acceleration stick all the way forward when it comes to the Charlotte market. We look at the overall market, what's happened. Wall Street's entry into the single family rental market began after the 2008 housing crisis. It's continued to, rise since that point. Institutional, and obviously this year lower than the last couple of years. We just covered that here in the hot sheet. With institutional investors owning 3% of all single family rentals nationwide by June 2022. From so 2008 to June 2022, institutional investors ended up owning 3% of all single family rentals. Okay, remember, not all single family homes. The single families across the US that are categorized as rentals. Okay. They own 3% of that. So 97% of the single family homes that are being used as rentals are owned by investors that would not be categorized as an institutional investor. Okay. An institutional investor would be 1,000 homes or more. Okay. Ownership of 1,000 plus homes. We actually went through, which day was this? I think it was on Tuesday's hot sheet. It was Tuesday's hot sheet. You can go back and, give a replay to Tuesday's hot sheet, or you can get it on Apple and the number of places there. You can go back and look at the breakdown on some of the, on the whole topic we did on institutional home buyers right now. If you remember this table, which happens to be in the daily downloads for all of our BAMX members, use code HOT to get 10% off of BAMX, of course. You had access to this table on Tuesday. It's still there. Housing inventory, this is looking at, okay, how many of them are starting to sell some of the homes? Not many. Most of these institutional buyers, the institutional investor, are holding the real estate. They're not looking to sell right now. You don't see anybody, despite this bill just being proposed, rushing to the market to sell these homes. Vinebrook is the most, where percent of the single family homes that they have owned, 2.9% they have listed. But the more telling stat of, I think, how much they've slowed down on the buying side, not in Charlotte, but across the country, would be the one where they've only bought up 2 point. Here we go. Let me just find it here. 0.4%, I believe it was. I'll bring that stat up. Maybe you can. Okay, here it is. I got it. Institutional landlords accounted for only 0.4% of home purchases in Q2 of this year. So just 1 out of 250 purchases across the U.S. Very different from Charlotte. Okay, where Charlotte, we just mentioned, in June alone, which was the last quarter of Q2, June alone in Charlotte, institutional investors bought 1 out of 4 homes. Across the country, though, in Q2, these institutional investors only accounted for 0.4%, not 26% like in Charlotte. So overall, 1 out of 250. That's way down from the 1 out of 42 home purchases that institutional investors were doing in Q2 of 2022. So got to be careful when we're talking about home purchases. That's one thing. And then when we say how much of a percent of the rentals do they own, that's a whole nother thing. But I would definitely say that what's happening in Charlotte is a travesty for people who want the dream of home ownership, who want to be in a single family home. Institutional buyers buying up 26% of single family homes in June of 2023 is absolutely crazy. Proponents, of course, argue that the legislation aims to address the concentration of wealth and commodification of housing. Critics, on the other hand, such as David Howard of the National Rental Home Council, argue that the real issue is a lack of new housing. I think this issue still remains whether this bill goes through. I agree with this. I'm not saying I take David's stance that this bill should be stopped. What I'm saying is his argument that the real issue is a lack of new housing is absolutely correct. Of course, he points to the number that we all know. He says we need 2 to 6.5 million new housing units. We've seen that number as high as 7.5 million, even higher than the number he referenced. Now, it doesn't mean that this bill should not move forward. You certainly can't have a situation like you have in Charlotte, where institutional buyers are buying up 1 out of 4 available homes on the market in a month like June. It's insane. The divided Congress makes it uncertain whether the bills will pass into law in the current session. Legislators emphasize the need to initiate conversation about the impact hedge funds on the housing market. Since Democrats proposed this bill, this gives them the ability, coming into an election year, to go on the campaign trail and say, we're the only ones that are proposing bills to increase the supply of housing. We're the only ones that have a plan here to do something about the inventory issue. If Republicans were to push back on this bill, there's no indications in this New York Times article. They're just mentioning that there's a divided Congress. There's always a divided Congress. There'll probably always be a divided Congress. So they're not saying that Republicans are pushing back. To my point at the top of the segment, I would argue that if they do push back, that's bad PR, right? For the average American, we went through the numbers earlier in the week that are either rooting for a housing crash or don't believe that they'll be able to buy. The mindset of the consumer, if they hear there's a group in Congress that are trying to support Wall Street buying more of the single family homes and further exiting them out of the market, the consumer, and further into, you know, a rental situation that they're going to say what that doesn't make sense. So we'll see what stance if this becomes bipartisan, um, if this becomes a sticking point for other members of Congress, and if this becomes an argument, we'll see if this even actually goes through. Again, this is a proposed bill. I wanted to break it down for you. Expect an article on nowbam.com at some point, further going through the details of the 14-page bill. All right, let's jump into some more Wall Street news. Okay, 8% mortgage rates, according to Lance Lambert at Resi Club, have not crushed the U.S. home builder. He points towards their earnings reports uh, for their stocks to make this case. U.S. home builders are resilient right now, and they continue to report robust earnings by implementing affordability adjustments and capitalizing on factors like tight resale inventory and expanded profit margins. Okay. Here are some performance metrics. Let's look at Toll Brothers. It's a luxury builder. Per their definition, reported solid demand in the fourth quarter, signing 2,038 net contracts at an average price of $989,000. Contracts are up 72% in units compared to the previous year's fourth quarter, reflecting a strategic shift to smaller homes. That's a big price point to get a 72% unit pop compared to 2022's fourth quarter for Toll Brothers. The CEO, Douglas Yearley, is optimistic about the market outlook, citing favorable demographic supply demand imbalance and the aging of existing housing stock. This is going to continue to be an issue moving forward. The age and quality of the homes that we have in America. Every year that goes by, you can find more and more homes that should really be lots, and really shouldn't exist anymore with today's standards, or need a complete renovation. The company's strategy includes broadening home offerings to include lower price points. Well, yeah, $989 is pretty much not affordable for most Americans, Toll Brothers. Increasing the supply of spec homes and growing community count. Okay, so going a little bit further, here's the earning reports and how well these publicly traded home builders have done. You see here that since 2021, all of them have outperformed earnings and net income by quarter going back to 2015. These have been by far the best 2 years. And specifically here this year, still continuing to do well, from the Taylor Morrisons of the world to the KB Homes to the Lennars to the DR Hortons, and even the Pulte groups down there at the bottom. All right. So publicly traded home builders continuing to excel. Many are projecting a big year for home builders across 2024. Toll Brothers right now cleaning up on the margins as well. Margins for Toll Brothers, quarterly gross margin comes in at 26.5%. You've seen, as low as 13% in the bottoming after the GFC 2009-10, going into 11 time frame. The highest margins they hit were in 2005, up over 30%. So they are at those near peak levels for overall margins for Toll Brothers, despite where the rates are at. Speaking of mortgage rates, applications right now are up in the latest MBA weekly survey. Mortgage applications, again, I think this is now 3 or 4 weeks in a row, maybe 4. Mortgage applications increased 2.8% now from 1 week earlier, according to MBA. Mortgage rates declined last week. We know that, with the 30-year fixed mortgage rate falling to 7.17. We have good news that it got even better yesterday, the lowest level since August of 23 now. Slower inflation, financial markets anticipating the potential end of the Fed's hiking cycle are both behind the recent decline in the rates. So mortgage applications, mortgage demand continuing to go up at a time of year that is seemingly abnormal for that type of activity here in the between holidays weeks. U.S. consumers, though, according to CNBC, will soon wake up to out of control interest on their credit cards. This is according to economists. Consumer spending is being financed by credit cards where interest is over the top, out of control, off the hook right now. Economist Carl Weinberg told CNBC, off the hook. Man, this is one hip economist. Weinberg sees retrenchment in spending in the new year. As debt burdens rise, they'll probably not enough to push U.S. economy into a recession. You continue to hear this. Savings are depleted, and this is where consumers are going to have a tight financial situation in 2004. If the rate can continue to come down, that can be the biggest boost, obviously, to affordability. I don't see a surplus in inventory, despite Congress's efforts here with this bill. But any inventory will help. Ultimately, the 30-year fix is what helps us the most. Right now, we have a 10-year that is at 4.136, which is pretty good. We've been trending down on that. And we had again, not only last week at 717, the lowest since August 2023. This is the lowest we've seen in quite some time. Yesterday's reading on the 30-year fix at 7.04, almost a 6 handle again, according to Mortgage News Daily's daily survey. Get the most out of our content here by using code HOT to get 10% off of BAMX. For those of you that have been with us this week, you know that starting Monday, BAMX members are going to get access every single day to the hot sheet show notes. This was today's hot sheet show notes broken down by segment. You're going to get my actual notes each and every single day if you're a BAMX member. That starts on Monday, so you can get into BAMX today by using code HOT to get 10% off of that. All right, have a great day. See you back here tomorrow. It's a free format Friday. Looking forward to answering any questions that you have and talking about the latest news in the last 24 hours for housing. Have a great day. Until then, toodaloo.